Quick disclaimer before we start, this is education, not personalized financial advice. Always check your own situation or speak with a licensed advisor before acting. Now, if you're a European investor holding a plain S&P 500 fund, look closer at your statement, because part of that return isn't stock market performance at all. It's the euro-dollar exchange rate hiding in plain sight. Over the past 18 months, the dollar has had one of its worst stretches in years, and depending on which S&P 500 product you actually own, that currency swing has been worth several percentage points of your annual return in either direction. Today, the real numbers, the actual mechanism behind it, and what you can realistically do about it. Start with 2025. The US dollar index, DXY, a broad basket measure against major currencies, fell 9.4% over the full year. That's the steepest annual drop for the dollar since 2017. The Federal Reserve cut interest rates 3 separate times, 75 basis points in total, while the European Central Bank largely held its ground. Cheaper dollar rates plus a steadier euro pushed the exchange rate hard in one direction, and that direction mattered enormously for anyone holding American assets from a European bank account. Look at the actual exchange rate, not just the headline. In January 2025, 1 euro bought about $1.04, practically parity. By the end of that year, 1 euro bought roughly $1.18. That's close to a 15% move in 12 months. 2026 has cooled a little, drifting back toward around $1.14 by July. Still far above where 2025 began, and nowhere near a settled stable rate. Here's the mechanism, and it's simpler than it sounds. Most popular S&P 500 UCITS ETFs hold their underlying stocks in dollars and do not hedge the currency. So your euro return is really two numbers multiplied together, not added: how the US index performed in dollars and how the dollar performed against the euro over the same period. When the euro rises against the dollar, every dollar of American stock gains converts into fewer euros, quietly shrinking the return you actually see in your own currency. Even in a year, the S&P 500 itself did well. Put a number on it. Say the S&P 500 gains 20% in dollar terms over a year, and the euro rises 15% against the dollar over that same stretch. An unhedged euro investor doesn't get 20%. The math works out closer to just 4% once the currency move is folded in. Same index, same year, a completely different result depending purely on which currency you're measuring it in. You can see this play out with real products, not just hypotheticals. Take the standard iShares Core S&P 500 UCITS ETF Unhedged against its currency hedged sibling, the iShares S&P 500 EUR Hedged UCITS ETF. Over the trailing 12 months, the unhedged version returned about 22.9% in euros. The hedged version returned about 17.4%. That's a 5.5 point gap between two funds tracking the identical index. The entire difference is currency. Notice something important in that comparison. The unhedged fund actually won. That's because the euro's big rise happened mostly during 2025, and the rate has pulled back a little through 2026. So currency has recently been a tailwind for unhedged holders, not a headwind. This is the part investors miss most. Currency risk cuts both ways. The same kind of move that would have punished unhedged investors during the 2025 rally became a modest gift once the trend paused. Never assume it always works against you or for you. And this isn't unique to S&P 500 trackers. Broad global index funds like MSCI World or FTSE All World typically hold 60 to 70% of their weight in US stocks. So if you own a plain global tracker instead of a specifically American one, you are carrying a very similar dollar exposure, just diluted slightly by the rest of the world. Checking whether your so-called global fund is really a dollar bet in disguise is worth 5 minutes with your fact sheet. Most fund providers publish the country breakdown for free, and the number is usually higher than people expect. It helps to see that fee in real money. On a 10,000 euro position, a 0.13 percentage point gap in ongoing charges works out to roughly 13 euros a year. Not dramatic on its own, but it compounds every single year you hold the hedged version, regardless of which way the currency actually moves that year. Over a decade, that is a real guaranteed cost paid in exchange for an uncertain benefit. So which way from here? Major banks are not shy about calling for further dollar weakness. Goldman Sachs projects the euro near $1.25 by year end. JP Morgan and ING both sit around $1.22. Scotiabank is close behind at $1.24. If even the more conservative of those forecasts proves right, the euro likely has another meaningful leg higher against the dollar still ahead in 2026. The reasoning behind those forecasts is fairly consistent across banks. Traders expect the Federal Reserve to keep cutting rates as the US labor market cools, while the European Central Bank holds closer to its current level. Lower US rates typically make the dollar less attractive to hold, all else equal, the same dynamic that drove 2025's move in the first place. None of these forecasts are guaranteed. Forecasting currencies is notoriously difficult, and the actual range banks quote for year-end spans well over a 10-cent band, which itself tells you how much uncertainty is baked in. Still, the direction of the consensus is worth noting. So what do you actually do with this? Broadly, 3 choices. Stay unhedged and accept currency swings as the price of owning foreign assets. This is what most European retail investors already do, often without realizing it. Switch some or all of your US equity exposure to a euro-hedged share class, trading away currency risk for a slightly higher ongoing fee, or simply do nothing differently, but understand exactly why your returns look the way they do, which, for many long-term investors with decades ahead of them, is a perfectly reasonable answer on its own. That hedge isn't free though. The Unhedged iShares Core S&P 500 fund charges 0.07% a year. Its EUR hedged sibling charges 0.20%, nearly 3 times as much, a gap of 13 basis points every single year. And the hedge itself is never perfect, since it resets periodically against a moving portfolio value. Over a long time horizon, many investors decide that guaranteed extra cost isn't worth paying to smooth out a currency risk that, across full market cycles, has historically tended to average out closer to zero. Let's bring it together. The dollar had its worst year since 2017 in 2025, and the euro rose roughly 15% against it. Hedged and unhedged S&P 500 ETFs can differ by 5 points or more in a single year, purely from currency, on top of a real, ongoing fee difference between the two products. Right now, that gap has actually favored unhedged holders, but major banks still expect the euro to climb further in 2026. Know which version of the index you actually own, and don't mistake a currency move for stock picking skill in either direction. If this helped you understand your own S&P 500 holding a little better, like this video and subscribe to The European Investor. We break down exactly this kind of hidden mechanic every week. Once again, this was education, not personalized advice. Check your own portfolio and talk to a licensed advisor before making any changes. See you in the next one.